trader with $10 in his account stared at the same charts as the trader with $10 million. Same price action, same patterns, same opportunities, yet one sees setups everywhere while the other waits hours for a single entry. One trades every minor bounce while the other ignores most of the market noise. One calculates position size based on how much he wants to make while the other calculates based on how much he's willing to lose. The difference between these traders has nothing to do with capital, education, or market access. It's a fundamental rewiring of how their brains process opportunity, risk, and time itself. Million-dollar traders don't think faster or analyze better. They think completely differently about what trading actually is. What I'm about to reveal are the 3 cognitive frameworks that separate scalable mindsets from broke mindsets, and why most traders stay trapped in small account thinking even after they get larger accounts. Section 1. The inverse risk. Small account traders think in terms of how much they want to make per trade, while million-dollar traders think exclusively in terms of how much they're willing to lose. This cognitive reversal completely transforms how you approach position sizing, setup selection, and trade management. When your brain starts with loss acceptance rather than profit expectation, every decision gets filtered through sustainability rather than opportunity maximization. The paradigm shift happens when you realize that protecting capital is the only skill that scales infinitely. A trader with excellent profit maximization skills but poor loss control skills will eventually blow up regardless of account size. A trader with excellent loss control skills can compound any account size systematically over time. This is why professional traders obsess over their maximum loss per trade but remain flexible about their maximum gain per trade. Inverse risk thinking rewires your setup selection process completely. Instead of looking at charts and asking, "How much can I make from this?" you ask, "What's the most I could lose and still feel comfortable taking the next trade?" This mental filter eliminates setups with unclear risk parameters and keeps you focused on trades where you can define and accept the worst-case scenario before entry. The psychological transformation involves training your brain to feel excited about controlled losses rather than anxious about missed profits. When you take a small, planned loss according to your rules, your risk control system worked perfectly. When you avoid taking a planned loss and hold hope for recovery, your risk control system failed regardless of whether the trade eventually becomes profitable. You're measuring different variables than amateur traders. Advanced practitioners develop what's called loss budget psychology, where they allocate a specific amount of capital to lose each day, week, or month, then trade within those parameters without emotional attachment to individual outcomes. This approach removes the psychological pressure that comes from needing trades to work and replaces it with systematic capital allocation that can handle inevitable periods of market uncertainty. But even perfect risk control means nothing without the second cognitive framework that determines whether your edge actually scales. Section 2. The process worship. Million-dollar traders have trained their brains to derive satisfaction from process execution rather than from financial results. This neurological rewiring allows them to maintain optimal decision-making during both winning and losing streaks because their reward system isn't hijacked by short-term outcomes. They literally feel good about following their system regardless of whether it produces profits on any given day, week, or month. Process worship develops through deliberate practice of celebrating adherence to rules while remaining emotionally neutral about results. Every time you follow your predetermined entry criteria, maintain your position sizing discipline, or execute your exit plan according to system rules, you consciously acknowledge the successful process execution. Over time, your brain learns to associate satisfaction with behavioral consistency rather than with account balance changes. The neuroplasticity aspect involves rewiring dopamine release from outcome-based triggers to process-based triggers. Amateur traders get dopamine hits from winning trades and dopamine crashes from losing trades, creating an emotional roller coaster that impairs judgment. Professional traders train their brains to release dopamine from rule-following behaviors, creating emotional stability that supports clear thinking regardless of market conditions. Process worship also immunizes you against the psychological trap of changing systems during inevitable drawdown periods. When your satisfaction comes from executing your process correctly, temporary poor results don't trigger that something is broken response that causes system abandonment. You can stick with proven approaches during difficult periods because your reward system isn't dependent on immediate validation from profits. The advanced application involves developing multiple process metrics that you track independently of financial results. This might include setup quality scores, rule adherence percentages, or emotional regulation ratings. These metrics provide feedback about your trading development that's completely divorced from market randomness, allowing you to improve systematically even during periods when your edge isn't manifesting in profitable trades. Understanding process worship prepares you for the final cognitive framework that determines whether your success can compound or will eventually plateau. Section 3. The temporal arbitrage. The most profound difference between small account and large account thinking involves time perception and patience application. Million-dollar traders understand that their edge unfolds over extended time periods and position themselves to capture value that impatient traders can't access. They've trained their brains to feel excited about waiting rather than anxious about missing opportunities, viewing patience as a competitive advantage rather than a constraint. Temporal arbitrage means recognizing that most traders operate on compressed time horizons that force them to take suboptimal trades to generate activity and psychological stimulation. While others are scalping noise for tiny profits, temporal arbitrage practitioners wait for high probability setups that offer meaningful risk-reward ratios. They're trading against other people's impatience rather than just trading against price movements. The psychological mechanism involves reframing waiting periods as accumulation phases rather than missed opportunity phases. When your setup criteria aren't present in the market, you're not missing trades, you're building psychological capital that allows you to act decisively when your edge finally appears. This mental reframe transforms periods of inactivity from frustration sources into confidence builders. Professional implementation requires developing what behavioral economists call present buyer's resistance, where you train your brain to value future outcomes more highly than immediate gratification. This involves specific mental exercises where you practice delaying gratification in non-trading contexts to strengthen your patience muscles for trading applications. The goal is building psychological infrastructure that supports long-term thinking under pressure. The compound effect emerges when you realize that patient traders don't just make better individual trades, they also preserve mental and emotional capital during low probability periods. While impatient traders exhaust themselves taking marginal setups and dealing with emotional volatility from overtrading, patient traders remain fresh and focused for the moments when edge actually appears. Their patience creates energy efficiency that compounds over time. Advanced temporal arbitrage involves understanding market cycles and positioning your psychology to capture value from other traders' cyclical mistakes. During high volatility periods when everyone is overtrading, you become more selective. During low volatility periods when everyone is bored and forcing action, you become even more patient. You're always trading against the emotional state of the market rather than with it. The ultimate realization involves understanding that your time horizon determines your available edge. Short-term traders compete against algorithms and institutional systems designed for speed and efficiency. Long-term traders compete against human psychology and emotional decision-making. The longer your time horizon, the more you're trading against predictable human behavioral patterns, rather than against superior technology and information access. Comment below and tell me which cognitive framework you need to develop most: inverse risk thinking, process worship, or temporal arbitrage. Because scaling from small accounts to large accounts requires fundamentally rewiring how your brain processes trading decisions. Master these 3 mindset shifts, and you'll discover that account size becomes irrelevant, because your thinking patterns can operate effectively at any scale. Your brain will try to convince you that bigger profits require bigger risks, that results matter more than process, and that good opportunities won't wait for you. Install these 3 cognitive frameworks and trading becomes what it should be for scalable success: systematic risk management with patient capital allocation and process-focused execution, not gambling disguised as opportunity recognition.